Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it's July 12th. We got a few economic news releases to go over today, so we'll jump right into it, and we'll start off with the initial jobless claims that we get every Thursday. So last week's report came out with 232,000 people apply for unemployment. This report for last week was supposed to be 225 was the forecast, and it came in at 214,000. Now, of course, we did have a short week due to the 4th of July and everything. But again, good number overall there. Now we got the more inflationary news. This is kind of a big report here, as it is the CPI or Consumer Price Index. This is a gauge that we kind of look at because it is inflation on the consumer side of things. And as you can see, back in May, it went up 0.2%. And forecast for June was supposed to go 0.2%, but it came in a little bit lower. The headline number came in at 0.1%. So our year over year went up from 2.8 to 2.9%, which is obviously pretty high. These are relatively high inflation numbers, which I think is around 2008 since we've seen these type of numbers here. Now, when you take out food and energy, we get what they call the core, and this is supposed to help us out with determining the real number here because of the volatility between those two, and those are things that we cannot control. So they like to look at more the core. And as you can see, back in May it went up 0.2%. Forecast was 0.2% for June, and it went up 0.2%. And this one went up year over year from 2.2 to 2.3%. And again, this is really the number they're looking at in terms of inflation, so they look at more at the 2.3%. So again, this is something to keep eye on for. We are getting kind of a healthy growth here because we're starting to see quite a few different things from jobs, wages going up. We're starting to see, of course, rents and everything else is kind of rising up as well. So again, and then with the tariffs coming in, we may see, stronger dollar. We may have, higher costs on our goods coming in here. So again, that's going to probably lead to a little bit more pressure in terms of inflation as well later on as well. And what does that mean? It pretty much means that the Fed is going to continue its rate hikes. So we know for certain there's going to be one in September. At first for December, which would be the fourth rate hike, was 50-50. But the odds of that have raised after the June meeting. It did indicate that the economy is on a pretty strong path, that it could be warranted for December as well. So we could have 4 rate hikes this year. Next year, it's projected about 3 rate hikes. So again, we'll have to kind of wait and see. But what does this also mean is that when we're looking at the yields on the 10-year as well as the 2-year, they are getting pretty close to becoming an inverted yield curve or a negative yield curve. And that usually historically translates into a possible, which usually leads us into a recession, primarily because businesses rely on those short-term rates to help function its business activities. And if those costs are greater than the long-term rates, then they may have some issues continuing their day-to-day operations. So let's kind of move on here to the headline news. The stock market is up today after a disturbance yesterday when there was concern when it was announced that President Trump would be releasing another round of tariffs on the Chinese, about $200 billion worth, which will determine late August. What exactly those are will be 10%, but again, we don't know what products and types of goods that would be, and that would be implemented towards the end of August. But today there's some optimism brewing that U.S. and China at a higher level will be talking trade talks, that they might be able to find some type of bilateral agreement, hopefully in the near term, that rather than continue playing this out. And of course, there's some talk as to how would China respond to us putting tariffs on $200 billion when, in fact, they don't even import that much to us. So they've been going for dollar for dollar matching our tariff talk. Now we're going higher. We're putting almost the whole thing, and now they're trying to figure out as to, they're not bringing in as much. So how do you compete at that level? So let's see how this is affecting the bond market here. The bond market did start off earlier this morning, testing the 25-day moving average. We're still in between this tough range here, where we got double layer of ceiling here. We got the bottom of the Again, floor support from the 25-day moving average. Currently, we're only down about 3 basis points from where we left off yesterday. You can see, as you can see, we did test it yesterday and did rise up. Same thing today. We're down about, again, about 3 basis points. So not enough for a change in pricing from where we left off yesterday in terms of rates. So interest rates should be about the same what we left off with yesterday. 10-year Treasury, sorry about that. We have a wrong picture there. But anyways, you guys have a great rest of your day. If you guys want to get more updates, just come over to Twitter. You can find me at Mike Bjork on Twitter. And enjoy the rest of your day. Thanks so much for watching. I look forward to see you guys tomorrow. Bye-bye.